What's up, guys? This is Alex Cohn, co-founder of the Hall Street Fund, co-founder of the Student Managed Investment Fund, and I was for all 4 years head of research. I taught everyone the fundamentals of equity analysis, uh, mentored many people through stock investing. I myself have been investing and researching stocks since I was 12 years old. So yeah, um, now my goal is to spread my knowledge and get other people interested and hopefully passionate about equity research. And with that, let's start investing. So in this presentation, I'm going to be covering a company that we will be talking about to give us a frame of reference for how to even look at a company, how to find a company, and what we're all interested in is how to value a company. So I picked Disney, of course, by the logo, needs no introduction, but we're going to give a brief introduction in the slides ahead. So when we're thinking about a company, let's take a really big step back to the world, more specifically, global forces. And the most commonly used framework to understand this is an acronym called STEEPLED. That stands for S for social, T for technology, E for economy, E for ethics, politics, legal, environment, and lastly, demographic. So with social, so we think about health, not just the availability of healthcare, but also what is the health environment? Are there any pandemics? Like right now with coronavirus, how does that impact just the way we evaluate stocks, the way we evaluate just general global economics? And then we can think about just cost of drugs, that goes with pharmaceutical companies, pervasive health issues, like what does Medicare for All in the United States mean for companies not just in the healthcare industry? And then we can think about stuff like family construction, how long are people staying in their houses after they graduate college, what's the divorce rate, and then state of living. So that's like, how great are people living? Are people, what's the percentage of people in poverty? And then culture of food, when we think about, Starbucks, what's the percentage of coffee drinkers versus tea drinkers, and just assessing a market. And then next we have technology. So obviously there's many trends in technology like 5G, AI, artificial intelligence, IT spending. So many companies are spending a lot of money on these things. Stuff like blockchain, just phone access. So think about how many phones there are in the world. And then think about, for example, a shift. This involves Disney directly from traditional movie theaters to more streaming services like Disney Plus, Hulu, Netflix, and all that other stuff. And then you have stuff like smart cities, autonomous driving, Internet of Things, IoT. Then we have economics. So obviously some basic terms to know is GDP, wage growth, unemployment participation rates, interest rates. You have a bunch of debt that's negative yielding, around 14 trillion to say the least, although I'm pretty sure that number is probably higher since the last time I looked at the figure. And then you have stuff like, liquidity and fungibility of assets. And just for some of you that may not know, liquidity is basically a good way of measuring that is the bid and ask spread. Obviously, the closer the bid and ask spread is of an asset, the more liquid it is. It's basically the easiness of buying and selling a stock price at its listed price. And then fungibility of assets, basically how easy it is to convert an asset to cash. And then next we have ethics. So when people say ethics, just think about ESG. So that's sustainable investing. There's been a huge shift to sustainable investing. You have the corporate roundtable. Jamie Dimon has led that. And basically trillions of dollars are going into sustainable investing, companies that favor ethics. What does that mean for a traditional fossil fuels company, or a company that prioritizes, their consumers, their stakeholders? Obviously, they might attract more investing. And then we have politics. So obviously stuff like a switch from globalism to nationalism. You have a bunch of protests going on in various countries, trade agreements, tariffs, that whole tariff trade war that was happening with China and the United States, also known as the Sino-American Trade War. You have embargoes, military actions like in the Middle East. You have taxes, which we'll talk about in a bit when we get to legal, and then you have fiscal policy. So fiscal policy is basically just the government stepping in to do stuff like infrastructure spending, that's stuff like building bridges, building roads. What does that do to the employees of a country? And then we have legal. So it's a little boring, but you kind of have to dig in terms of just general, like on the company level, you can check out lawsuits, and then on a global level, you can think about an organization like OECD. For those of you who may not know what OECD is, it's basically a group of a couple dozen countries that set global tax policy, trade policy, and other types of things. And you also have like the EU Commission. Obviously, the United States in its current environment is not really setting any laws just because of how divided everything is. So when you're looking for just global compliance and legal leadership, it's coming out of the EU, not from the United States, unfortunately. And then you have stuff like IP protection, like things that in China, that was a big issue. So that's important to understand. Also, another thing is, like in India, for example, there's a bunch of new legislation in terms of just companies' ability to expand into India. This has been enormously problematic to companies like Amazon and Walmart, to be specific, which we won't go into because it's a little bit more complicated. And then next we have environment, so stuff like green energy, a shift from fossil fuels to more renewable sources of energy. You have stuff like climate change, global warming, which is obviously getting all sorts of publicity. Greta Thunberg and her whole growing green movement, and then the possibility if we get a Democratic official elected like Bernie Sanders, we might see like a Green Deal. Basically, governments around the world are devoting trillions of dollars to try to combat climate change. So what might that mean for a fossil fuel company versus like a solar panel seller, etc. And then you also have weather. So with global warming, specifically now in the United States, we've seen a very warm winter. So obviously that keeps natural gas prices super low. So the demand of natural gas goes down. So what does that do to prices and the companies that sell that stuff? Yeah, and then that deals with crops, like coffee prices, cocoa prices, etc. And then lastly, dealing with just global forces is demographics. So that's stuff like age, gender, sex, religion, all this sorts of stuff. Basically, companies use to identify their consumers. That goes to advertising and just being able to build out products. So if you think about Disney sells stuff like Marvel, Lucasfilms, which target a broader demographic, and then you have stuff like Disney Junior, which targets a much more narrow focused people aged 3 to 5, and then you have Disney Channel, which is like 5 to 13, although I still watch reruns of Sweet Life of Zack and Cody on Disney Plus. I used to love that show growing up. So obviously there's a whole nostalgic factor with Disney, which is something I think is an enormous strength for them. Okay, so next, after global forces, we have corporate forces. So we're going to talk about evaluating comparable companies, also called competitors, strategy. So I'm going to pick a specific strategic framework to understand Disney, and then we're going to dive into financials, corporate actions, and then finally modeling, finding out how to value a company. So let's start with competitors, comparable companies. So we're going to start with identifying the top 15, going into different metrics like profitability margins, growth rates, leverage, coverage, etc. And then we're going to finally arrive to valuation. Okay, so let's start with top 15. Well, first we have to identify the names. Next, we identify the size of the companies in terms of just market capitalization. So we organize it into three main tiers, the large ones, the medium ones, and the smaller ones. And then we take a look at the total market share of the top 15 in terms of sales, and we basically calculate a percentage of sales for each of the competitors, including our company. Then you dive into the business description, mission statement, purpose statement. Remember, you can find all of this information in item 1 on the 10K. It usually gives a brief but helpful description of a company, what type of products or services they sell, any brands that they're a part of, and any divisions. And if you're ever wondering where do you even find these names, well, you can use something called GICS, also called Global Industry Classification Standard. And in GICS, there are 11 sectors, and the sectors are very simple to understand. All they are is energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, telecommunication services, utilities, and finally real estate. So first you have to identify which area of the market in terms of sectors you're interested in, and then you can compile a list. Basically in the S&P 500 index, they have GICS indicators for sector, industry, and then sub-industry. So you can build a very easy list of top 15. And something else, if you can't find 15 companies within your sub-industry, what you could do is you could broaden out your search to the industry, create maybe a synthetic company, like we'll talk about in a little bit. In that synthetic company, you'll basically take a division of another company that's similar to your company or of the group of the top 15. Oftentimes in 10K, companies will break out revenue, EBITDA, depreciation, amortization, capital expenditures of that specific division, and then you have enough information actually to basically treat that division as its own, I call, synthetic company. Okay, and then once you identify your top 15, we have to go in and calculate various profitability margins like gross profit margin, EBITDA margin, getting down to profit margin, like also called net income percentage. And then CFO, for those of you who may not know, CFO stands for cash flow from operations, which we can find from the cash flow statement. And then EBITDA, if you don't know what that is, that's earnings before interest, taxes, depreciation, and amortization. So it's not on an income statement, but you can calculate it by just taking the operating income and adding back depreciation and amortization. Operating income is also called earnings before interest and taxes because we haven't yet deducted that and other stuff to get down to net income. And FCF is free cash flow. And free cash flow is simple to calculate. All of that is cash flow from operations subtracting capital expenditures. Okay, and then next we get to growth rates. So we have sales, that's revenue, EBITDA, and earnings per share. So growth rates is not just the actual number growing or shrinking. We can also think about market share. So even if a company's sales is flat, if the overall market share is decreasing, but a company's holding its revenue flat, it's technically growing its market share. So if you think about a pie that grows at 5% per year, and suddenly it goes down by, let's say, 10%. But our company, which was selling $100 of sales last year, this year it's still at $100. So it's market share grew even though its actual sales numbers didn't grow. So it's important to understand what exactly the numbers are, not just for your company, but also for its competitors, as well as looking back in time and seeing how that's transformed and, being able to project the future. What do you think sales are going to be doing in the next 3 years and 5 years or next year? Next, we have return on investment. So return on investments is, in very simple terms, it is basically how efficient a company is using its assets or capital and to generate a return. So it could be in the form of net income. And how we do that? Well, we would basically calculate something called an ROE or ROA, which is return on equity or return on assets. So return on assets is just net income divided by total assets, but there are, of course, more complex return on investment calculations like return on invested capital, which we won't go into. That's ROIC. It's a little bit more complicated, but these are just various ways of measuring a company's efficiency, and we can calculate trends, in the industry and then historical trends as well. And then we have leverage ratios. So obviously companies take on debt to expand their operations, to fund their operations. Then of course we can check what the industry does. So you can see total debt size, and then we can look at total debt in comparison to their earnings power or their overall size. And debt minus cash, you get net debt. Then you have coverage ratio. So we talked about with leverage, we talk about how much debt a company has relative to its earnings or its size. And then we have coverage, which is basically, just as it sounds, how easy it is for a company to make or cover its interest expenses. So obviously you want a company that has a very high EBITDA to interest expense ratio, because it's much easier for a company to just service its debt payments as the ratio is higher, versus if the ratio is not so high versus the industry or its historical average. That might be an indication that the company might be going bankrupt soon or may not be able to service its interest expenses. Then you have stuff like valuation ratios. So obviously a very common one is PE or price to earnings ratios, but there are other ones. A valuation ratio that I actually like to use better than price to earnings, because in my opinion, price to earnings is such a easy to manipulate number. Earnings per share, companies can do many things to manipulate that number, from buying back shares to cutting extreme amounts of cost cutting to just make their earnings per share go up, which we'll talk about a little bit what those implications are. So EV to EBITDA is much better. EV is enterprise value, and enterprise value is different than market cap. So market cap plus debt minus cash gets us to an enterprise value. And also you have stuff like percentage of 52-week high, so you can look at the price chart to see what does it look like this year or the last 5 years, where is the stock price in terms of just historical where it was trading before. And again, just because a company is down 40% doesn't mean that it's a good buy now. We have to do more research. Also, if a company's up 40% doesn't mean a company is too expensive, because it could go up another 40% or more. So you have to do more research. And then we have financials. So financials, we have 3 financial statements: the income statement, the balance sheet, statement of cash flows, and then we're going to go into earnings, capital structure, corporate structure, which we won't go into too much, but those are there to understand if you want to do more reading and research. Okay, so first we're going to start with income statement, specifically revenues. So how do we classify revenues? Well, we want to think about the major drivers, or basically how it is that a company makes money in terms of just what products or services they offer. And one of the other things we're going to talk about is adoption rates of the new product or service. So when we think about Disney Plus, as soon as they rolled it out, within 3 months, they went from 0 subscribers to 30 million subscribers. Netflix You may not know it took them almost a decade to get to 60 million subscribers. Again, there were different factors that affected Netflix 10 years ago. There wasn't really a lot of knowledge on just the way streaming services work. They basically invented the term binge watching. Smartphone screens, obviously 10 years ago, were a lot smaller than they are now. Now you can buy phones like the Samsung Galaxy S20 that has almost a 7-inch screen. So obviously the availability of just watching videos on the go, faster internet. Also, there's notion of cord cutting now. So all sorts of things that probably strengthen Disney, but obviously adoption rates is super important. Then you think about past trends. So we talked already about sales growth rates, so we won't go we won't really go much more into that, but just think about evaluating a company's revenue on the last quarter, last year, last 5 years, and also, again, going back to the industry. And then you have stuff like signs of time shifting. So if you think about like a PC seller, like HP, there's a whole declining trend in just buying PCs. Most people are just going to cell phones, going more to tablets, laptops. So that's basically a sign that a company's revenue sales growth rate declines are permanent, not just a one-year thing. And then lastly, how does percent sales compare to the percent of AR? So this is delta sales, delta AR. For those of you who may not know, AR is accounts receivable. So obviously, you don't really want accounts receivable to be growing faster than sales, because sales is your ability of turning accounts receivable into cash. Also, if your sales are growing much faster than accounts receivable, that's a good thing, because it means you're able to convert credit sales to cash sales. And then you have the expenses. So of course, just like with revenue, you want to identify the major drivers of expenses, their fixed and variable cost mix. So obviously having very high fixed costs like rent could be very risky for a company. Variable costs, if those are really high, it allows a company to rapidly shift its operations because it's not bound to any one massive fixed cost. And then you have past trends. So obviously the same thing with sales. You want to look at what were they 5 years ago? Did the major driver change, or did it dramatically change just in terms of percentage? And then past trends, you also want to understand that rising expenses aren't always bad. Obviously, if a company's spending more money on research and development, that's a good thing because it's investing for the future. So hopefully we'll be able to see those fruits a little bit later on. And also, decreasing expenses aren't always good because companies could be taking shortcuts. They could also be hiding expenses as well, moving things off the books. So that's another thing to watch. So just because decreasing expenses are rising or decreasing doesn't tell you the whole story. You really have to dig more into the details. And then next, you have interest expenses. So are they decreasing or increasing? And if they're increasing, why? Is it because maybe they took out a lot of debt to finance a recent acquisition that they did? Or is it because the general interest rate environment's going up? Or is it because the credit rating of a company was downgraded because companies like Standard & Poor's and Moody's or Fitch may have downgraded them because they had cash flow problems, so their ability to repay their debt is in question. Then we move on to the balance sheets. And so we're going to start first with assets. So I have cash up here, cash sufficient. So cash is always king. You want to make sure that there's enough cash on the books. A great balance sheet is somewhere where cash is greater than debt. And you also want to always check trends of cash. So are they really low cash? Are they at an all-time high in cash? Again, just because a company has a lot of cash also doesn't mean it's so good, because because a company that has too much cash could be inefficient, because it means that maybe they're they're not acquiring companies, they're not buying back stock, they're not paying off debt. You want to understand why it is they have so much cash, and could they be more efficient in deploying that cash to invest in the company. Then we have accounts receivable. So obviously trends like we talked about before, and the ability of turning accounts receivable to revenue. Those are important. And just in a concept called conversion cycle management in the form of day sales outstanding. It's a little more complicated. You can do more reading on that. Conversion cycle management is a very important metric to understand just how efficient a company is. And then you have inventory, so obviously trends. We're going to constantly be talking about trends, so just think every number you want to make sure you look at the trends, and you want to see, if there was a big spike in inventory, is it because a retail company wasn't able to sell all of the stuff on their shelves, or are they stacking up on a lot of inventory in anticipation that they're going to sell a lot? And then you have investments, so percentage of total assets. So obviously if they have too much of their assets in investment, could that be risky, because investments are typically classified as investments and not cash because of their liquid nature. They could be long-term assets, they could be tied in real estate and other investments. And then lastly, you have PP&E, which stands for property, plant, and equipment. So also you want to see what is the percent of total assets. Obviously, it's very high. That could mean that the company is very capital intensive. It could have, a lot of factories, a lot of stores, and obviously you want to look at trends. And when we talk about location, you want to see where the property, plant, and equipment is. If they're expanding their property, plant, and equipment through capital expenditures, where are they putting this property? And where you can find that information is on a company's 10K, which is an annual SEC filing. And then we jump into liabilities. So there are three main things to look at when you're talking about liabilities that I like to look at. It's accounts payable, so what are the terms? Another thing to look at is conversion cycle management, obviously trends. If accounts payables are growing faster than accounts receivable, that's not sustainable. Also, if accounts payable is growing faster than revenue, that's also not sustainable. So you have to really understand accounts payable. And then we talk into debt. So just what's the size of debt, trends. So if a company did a massive acquisition, obviously they're going to take on a lot of debt. You want to make sure you look at the terms to see if they're not too strict. When is the debt due? Does the company have a massive amount of debt due next year? And looking at the cash and the other stuff on their cash flow statements and everything, how easy it is for them to pay that debt. And if the company has a good credit rating, could they refinance that debt and push it back a few years in the future? So these are all good things to look at. And then equity, obviously, you want to make sure the company has positive equity, not negative equity, and who controls the equity. So you want to see, does the company have a lot of minority interest? Not only that, but could the owners of the company, like the founders, own most of the stock? So that could be like another thing to look at. Or are they mostly owned by mutual funds like BlackRock or Vanguard? And then we jump into the cash flow statement. So first we're going to start with operating cash flow. Now operating cash flow is a little different than net income because it's actually cash flows instead of just a line item on an income statement. I don't really even like to look at net income just because it's really easy to manipulate. But if you're comparing operating cash flows to net income or EBITDA, you really want to make sure that it's consistent. If there's 100% improvement in operating cash flow, but the net income actually dropped by 100% or 50%, those are some pretty big red flags, and you want to do more reading and research to try to understand why that is the case. And the next item on the cash flow statement is investing cash flows. So there's two main items that are most important. We have capital expenditures and acquisitions. And capital expenditures, for those of you who may not know what that is, those are basically just additions to property, plant, and equipment. Basically, money that a company uses to make its company bigger in terms of just building more factories, building out, let's say in the case of Verizon, 5G. In the case of Disney, is expanding theme parks. In fact, 75% of all of the capital expenditures that Disney deploys is for their theme parks. So those are some interesting things to note. And obviously you want to pay attention to magnitude and any big changes. So if any given year a company deploys, let's say 5% of their overall sales to capital expenditures, if all of a sudden you see that number goes to 10%, or maybe it goes down to 2%, you want to try to understand why. Usually management will give guidance to at least the next few years of capital expenditure spending, especially the larger companies like Apple or another company like that. Obviously, still want to make sure you pay attention to trends, comparable companies. So if our company in question spends, let's say, 7% of their sales on capital expenditures, well, what does that mean? Well, in an industry, let's say other companies might spend 10% of their revenue or even more. So either two things are going on. Either our company has a lot more sales and they just don't need to spend comparably as much on capital expenditures as their other ones, or maybe they're underfunding and underinvesting in their segment. So even though in the short term, maybe they show higher free cash flow, obviously because they're spending less money on capital expenditures, they might be poorly positioning themselves going forward in terms of just investing in the business. And obviously you want to make sure, it's sustainable. So if they're spending too much of their operating cash flow on capital expenditures, where are they getting that money from? If it's such a high percentage of sales, if their sales dropped, let's say 20% next year, could they even fund it? And then the next item is acquisitions. So this is a pretty popular item to throw around, but really all that acquisitions are is a company basically buys an asset or another company or maybe a company's division. And you want to basically ask yourself a few questions. How often are they making acquisitions? Are these very big acquisitions? Are they small? In the case of Cisco Systems, back when John Chambers was heading the firm, he was known as, constantly making these acquisitions. Are they strategic in nature? Goodwill impairment. So whenever a company buys another company, they typically pay a premium, let's say 30%. So that premium is basically, it's basically a sweetener of what the company is trading at. And a company recognizes that so-called sweetener on their balance sheet as something called goodwill. And, they'll test it every year for something called goodwill impairment. So if you see any massive goodwill impairment charges, you can kind of, say safely to assume that maybe that company didn't really make a great decision in buying that company. And, as far as goodwill impairment goes, there's trillions and trillions of dollars in goodwill. And you want to try to ask yourself a few questions. Was that acquisition successful? Did they pay too much for the company? Did they have to write it all off? Which can even question the management of the company. And then you have cost savings and earnings accretion. So when a company buys another company, like Disney buying 21st Century Fox, or when FedEx bought TNT Express a few years ago, or when Amazon bought Whole Foods. These are sometimes very complex transactions, and you don't automatically assume all of the earnings from the acquiree or the target company as soon as you buy it. It takes sometimes a long time. Sometimes it takes a few years actually to properly integrate the company, recognize those cost savings and synergies and all that good stuff. So you want to pay attention to the guidance that management is giving you on this acquisitions in terms of just forecasting future free cash flows from this acquisition. That's extremely important. And then you want to try to assess the type of integration. Is it horizontal? Is it vertical? So where on their capital structure is this acquisition going to take place? If they're in the case of Disney, and their studio entertainment when they bought Marvel, was that a vertical integration or a horizontal integration? You want to basically see, are they trying to become a conglomerate? Before this would almost be the case if Apple were to buy Disney's entire studio entertainment franchise. What would that mean in terms of just integration and expertise of a company? Then you have business transformation. So obviously, if Apple bought Disney's studio entertainment, that would transform the business because Apple traditionally doesn't really do studio entertainment. So that would transform Apple's business if they decided to do that. And of course, you want to compare it to competitors to see, are other people making acquisitions? How big are the acquisitions that your competitors are making versus you? How often they are? How efficient they are at integrating? All these are great questions to ask. Okay, and the next item is financing cash flows. So there's three main items that we have to talk about: debt, stock, and dividends. So in terms of debt, obviously, we sort of beat that over the head in terms of just leverage ratios and coverage ratios before, and just talking about magnitude of debt in terms, but obviously, we have to pay for it, and on financing cash flows, we can actually see how much money the company is giving out every quarter and every year in terms of just debt repayments. So you can also look at how sustainable that is on the cash flow statement, and of course comparing it to other competitors, there's just the trends, and comparing it to just your operating cash flows, your revenue, everything else. You want to just take a step back and look at the numbers. And then next we have stock. So are companies repurchasing a lot of shares? Are they issuing new ones? What's the purpose? So why might a company want to buy back a lot of shares? Are they just buying it to manipulate their earnings numbers? Why might a company want to issue shares? Recently, Tesla issued roughly $2 billion worth of shares. The purpose of that obviously is to pay their incoming debt, which is actually massive. I still don't know how they're going to be able to pay for it, but their stock was up a lot, so they noticed that that was an opportunity to issue more shares to try to collect some cash and shore up their balance sheet. They probably will have to do another capital raise. So this has all sorts of implications on a company. So this is a very important line item to pay attention to. And then lastly, we have dividends. So if we're buying a company solely on dividends, obviously we want to make sure that they can, one, afford to pay that dividend every year. So that's sustainability, payout ratio. You want to be sure that they can actually pay this, and you want to look at trends. So are they growing their dividends? Did they recently cut their dividend completely, or did they slash it? These are all important things to pay attention to. Okay, and then next we have corporate actions and reporting. So we already spoke about mergers and acquisitions, spin-offs, and asset sales. Companies can have new products offerings, they can change management, they can announce lawsuits, they can announce new product and service developments in terms of just, in our case, Disney saying that they're going to be releasing new Pixar films or new movies coming out, or in the case of pharmaceutical companies, announcing, a drug going phase 2 to phase 3, maybe their drug failed the trial, all that other stuff. So you can find all this information on their investor relations website, and you can also find their filings 10K, which is audited by accounting firms like PwC, KPMG, and on the SEC's website. Then you can also look at 10Qs. Remember, 10Qs are non-audited filings, but they're still important to look at. And then you can have S1. So when a company goes public, they file an S1. All these are great filings, and you can find them on the SEC website. Remember, a key point that I would note to anyone listening is you really have to do your reading, you have to do your research, and you have to do your homework. This is not a walk in the park. This is not something you can spend 10 minutes on and make an immediate decision. You want to make the decision based on what the information is telling you. You don't want to make an emotional decision. You want to really dig into the numbers. And obviously you have earnings calls and earnings releases. Those are all important to look at. I myself, when I'm looking at a company, I might listen to the last 5 years or 3 years of earnings calls of the company and just paying attention to the Q&A and all that other great stuff and information to get. Okay, and then next, obviously, that brings us to earnings. So companies, they release transcripts. You can look at trends and just the language. You can look at the analyst questions. I know actually there's some artificial intelligent software that actually can dig into the actual language of an earnings transcript, but it does help to take a look, closer detail, really listen to the tone of voice. Is management super euphoric on the earnings? Are they very defensive? Did they take very few questions? You know, if you have a quarter where the CEO, they take 10 questions and then the next quarter they only take 2 and they give very vague answers, that's a sign that management could be hiding something or they could be very uncomfortable with their earnings. These are all important to note. You know, management should be held accountable to their earnings every year and every quarter. So this is the opportunity for analysts to ask them questions on behalf of all of us investors. Then we already spoke about corporate actions, but you know, for me, when I look at a company, I typically go back at least 5 years. Sometimes a company that I've never heard of, I might go back 10 years in terms of just announcements, corporate actions on their 10Ks, on their investor relations websites, and then business model shift. So, you know, a company like, let's say, Bombardier. Some of you may not know what that company is. It's a Canadian company. They used to actually produce snowmobiles. They no longer are in that business. Then they went to, you know, airplanes. They're also no longer in that business. They sold that to Airbus. You know, they have a rail business, which, you know, they're in the process of selling to Alstom, and now they're basically becoming this private jet company. So these are really important to note, just the underlying business model of a company, their corporate structure, how is that changing? If you look at a company like General Electric, you know, they used to be a lot bigger. Now with the new CEO, Larry Culp, is doing all sorts of things, obviously cutting out divisions that are no longer profitable, try to raise money. He's trying to sell the healthcare piece to his old employer, Danaher. I don't know if there's a conflict of interest there. But yeah, he's trying to make all these changes, transformational. These are all things that you can read up on their investor relations websites as well as the SEC filings. Okay, and next we have modeling. So I'm really not going to go super in depth because each of these models, I could spend hours talking about each and every one of them. But it's important to understand that they do exist. You can do a lot more reading. There are whole books and resources that you can use to study any one of these. But we're just going to talk about them at a very high level. So let's start with precedent transactions. Now, this slide is just a very basic example of a precedent transaction models. These companies do not exist, but as you can see, how would we do this type of model? Well, we're collecting transactions for the industry. So let's say in your industry there were, I don't know, 10 acquisitions that were made. These are transactions in the past, which is why we call them precedent transactions. And whenever transactions take place, oftentimes, you know, they'll mention the value. How much did the company pay for them? You can see the valuation. So did the company pay, you know, an EV/EBITDA multiple of 10 times or 5 times, or in one of these examples, 18.8 times? So these are great ways of modeling out our company in question. Now, Disney, for example, has various divisions, theme parks, you know, studio entertainment. So obviously, when a company buys another theme park company or just a division, you can't really value it the same way that you'd value a studio entertainment company. So a way that we could do this in the case of Disney is we could actually look at the divisions and then strip out. So we could see theme parks had an average precedent transactions EV to EBITDA we can expect between, let's say, 8 to 12 times. And in the terms of student entertainment, that might have a much wider range, just given the fact that the student entertainment industry is much more complicated than theme parks. So maybe that range is, I don't know, 10 times to 25 times. And then you probably can average them, weight them based on size, and that's a great way to value a company. And next we have modeling RV. So this is a comparable companies model. This is actually a model that I built back actually in 2013 on ExxonMobil. Gosh, it's been a long time. So this is basically applying the top 15. This is where you identify your tier 1, tier 2, and tier 3 companies. On there we have Chevron, Schlumberger. Now you can actually build this for any company in question. So how you would do this is, obviously we talked about before with the GICS classifications. So you'd basically find your target company, look at the other 15, if you can find 15 in their sub-industry. If you can't find 15 in their sub-industry, try to look at the industry as a whole and maybe strip out certain divisions that are similar to your companies and sort of get a little bit more creative in terms of creating maybe, let's say, a synthetic comparable company. That's a little more complicated, but if you take a company, let's say like Disney, and I'm comparing it to Six Flags or Cedar Fair, which runs Dorney Park, obviously I can't compare the valuation of Disney Plus or Marvel to Dorney Park, but what I could do is I could strip out the revenues, valuations of theme parks and use that as a synthetic comparable company to compare to Cedar Fair and to Six Flags. And obviously this page is just valuations, but as we talked about before, we have profitability, we have coverage, we have leverage ratios, we have all sorts of ratios that we could do, and other metrics we can do to compare our company to theirs. And then next we have a discounted cash flow model. So this is a model I built with Merck actually in 2015. And when I was looking at Merck in 2015, obviously I have an implied share price of $60, and that was a 1-year target price. Obviously right now Merck is trading a lot higher than there, but basically in a nutshell, discounted cash flow, you have sales, cost of goods sold, gross profit, and then we take it all the way down to free cash flow. And our goal with a discounted cash flow model, again, we're not going to get super into the details, but just know that we're basically have a projection period. Typically that's 5 years. We try to forecast sales. We forecast margins to get down to free cash flow. We try to forecast capital expenditures. And then you can assign multiples on future EBITDAs. And you can try to basically back out to a market cap going to enterprise value. And there are actually much different discounted cash flow models that don't even talk about free cash flows. I've seen discounted cash flow models that only talk about price to earnings ratios. You do all sorts of this. This is basically just taking it into fact that we are actually applying a discount rate. Money today is worth more than money in the future. So that we use a WACC, or weighted average cost of capital. Again, it's a little more complicated. This is a very introductory, basic video, but this gives you a nutshell of another model that is very commonly used on Wall Street. And then second part, so I created a sum of the parts model for Merck back in 2015, and I arrived to a target price of $66.76 a share. So obviously this was 1 year. Obviously, Merck's still much more than this right now, but if you look at a sum of the parts model, you can sort of guess what it is. That's a list of all of Merck's drugs, basically forecasted every single one of them the next 5 years. Again, You don't need to be super accurate. The whole point is, how I got these numbers is I went on 10Ks, I compared it to other comparable companies. So in the case of Januvia and Janamet, what other companies are producing? What are their revenues? What are their management forecasts? The most important drug of Merck was actually Keytruda. I don't know if you can see it on that list, but Keytruda was it was basically the future of Merck, and now it's a $10 billion business. So it's critical to note that various divisions and drugs, in the case of pharmaceutical companies, you can actually break out their free cash flows and forecasts like that. And that's all I'm really going to say in terms of modeling for this video, at least. So now that we've talked about various fundamentals of equity research, now we're going to actually dive into a little bit about what Disney does and see if we can apply some of what we learned to Disney. So Disney is made up of 4 main divisions: media networks, parks, experiences and products, studio entertainment, and direct-to-consumer international, also known as DTCI. In this division, we have media networks, but let's take a step back. Any division has 3 main pieces: operations, revenues, and expenses. Operations, what products or services that they do or use to make money. Revenues is how do they use those things to make money, and what specifically are their sources of revenues. And expenses is, of course, what are the drivers of expenses for this division. So in the case of media networks, obviously this is, these are all TV channels. So these are things like the Disney Channel, ESPN, Freeform, which used to be called ABC Family, and now after the 21st Century Fox acquisition, they now own the FX and National Geographic channels. They own ABC Networks. They have a stake in A&E. And obviously they get revenues from these. So their main source of revenue is something called affiliate fees, which they collect from MVPDs, also called multi-channel video programming distributors. So what is an MVPD? Well, it's things like cable, satellite TV companies like Comcast, which obviously operate multiple channels, hence the name. And they also collect things from digital over-the-top, also called OTT. Now, what is digital over-the-top? Well, an example is Hulu TV or YouTube TV. So on YouTube TV, you can actually watch live ESPN. ESPN, which is owned by Disney, collects revenues from that in the form of affiliate fees. And they also collect revenues from advertising. So, and how do they basically assess how much advertising revenue to get? Well, they assess it based on Nielsen ratings. And I don't know what you know about Nielsen ratings, but Nielsen basically is a company that rates various shows and movies and properties to determine how much a company can charge or bill for advertising. And then we have, TV, SVOD, also called subscription video on demand. Again, these are all key terms for Disney's industry. You're going to find other companies in other sectors have other key terms to note. All these key terms can be found on the 10K, on their investor relations websites, on their earnings releases. These are all important terms to keep in mind when you're evaluating a company. And yes, so they collect revenue from subscription video on demand. So obviously you can collect revenue if Comcast sells you a Disney package. Anytime Comcast sells you a Disney package and you buy that, Disney collects a piece of that. And then you have expenses. So obviously Disney actually produces a lot of this content, so they have production costs. They incur residual costs. These are actor royalties. So obviously a show like The Sweet Life of Zack and Cody, even though it's no longer a live show, the actors still collect royalties whenever the show is put on a TV channel. And then of course you have very common expenses, SG&A, also called selling and general administrative expenses, and depreciation and amortization. And next, we have parks, experiences, and products. This is a massive division because it combines many different operations that Disney has. So first we have the theme parks and resorts, including ones in Florida, and California, and Paris, and Hong Kong, and Shanghai, and also Tokyo Disney, which actually isn't ran directly by Disney. It's ran by a third-party company. And Disney also has cruise lines, vacation clubs, National Geographic expeditions. Of course, they sell consumer products. So this would be anytime they sell an action figure from Marvel's, they collect money from that. And then their sources of revenue, obviously theme parks, they collect it in the form of ticket sales. They also get money when they sell merchandise, food and beverages in their parks, resorts, and cruise ships. They make money selling resorts and vacation nights. They sell merchandise licensing, and they collect royalties. They also have retail stores. I don't know if you've ever been to a Disney store before, but they sell various Disney products from Frozen. I'm sure there's going to be a lot of stuff from The Mandalorian, specifically Baby Yoda dolls. I would love to pick one of those up myself. And then they also have, sponsors, co-branding. So obviously if they sell Coca-Cola products, they'll get a piece of that. And then, of course, they're collecting royalties on Tokyo Disney resorts and theme parks. And then just expenses. So this is pretty much the standard expense structure. You have SG&A, depreciation, amortization. But obviously, when you're thinking about running a theme park or a cruise ship, you have all sorts of operating expenses like labor, cost of goods sold, when you think about just the merchandise that they sell. Infrastructure costs, obviously there's a lot of money that has to get deployed in terms of just hiring staff and security, making sure that all the rides are functioning properly, the cruise ships are functioning properly, obviously depreciation and amortization. So obviously there's depreciation on physical property that they have to recognize. And as I mentioned in an earlier slide, 75% of their capital expenditures goes towards theme parks. This is in the form of expansions and new attractions, new cruise ships, and just improvements and systems infrastructures. And you can actually find the company's future plans in their 10K. They outlined different plans of expansions going out, I think, to 2021 or 2022. All of that can be found on the 10K. And then another place you can find it on the 10K is something called MD&A, also called Management's Discussions and Analysis. And this brings us to the next division, studio entertainment. So studio entertainment is broken up by various subsegments. We have 21st Century Fox, Walt Disney Pictures, Marvel, Lucasfilms, and Pixar. And how Disney collects revenues? Well, they collect money from theaters through theatrical distribution. So AMC Entertainment, Regal Cinemas, Cinemarks, whenever they, or an IMAX theater, whenever they display, let's say, Avengers Endgame, Disney obviously makes revenue from that. Also, when they sell it to e-retailers or retailers and distributors like Walmart or Target, or online like Amazon Prime Video or iTunes or YouTube, they make money from that. You have TV or SVOD distribution in terms of licensing fees. So if you ever purchase like a movies on demand from Comcast and you got Avengers Endgame, Disney would collect revenue from that. And they also have, ticket sales from stage plays. So on Broadway, they have Lion King. They make money from that as well. And then expenses. So expenses are actually similar to media networks in the sense that Disney produces their own films, so they have to amortize production. They have residual costs, like, they have to pay their actors whenever they show a film that they already showed. And of course, they have SG&A and depreciation and amortization, and actually some interesting special expenses for the studio entertainment is Spider-Man and Incredible Hulk. As some of you may know, Disney pays Sony a licensing fee based on film's box office receipts, just because Disney doesn't actually own Spider-Man. Sony does for now. And Disney actually doesn't own The Incredible Hulk. Universal Pictures does, which is owned by Comcast, which is probably why we will never get an independent Incredible Hulk movie, because unless Disney buys it from Comcast, they won't be able to do it. Now, interestingly, in terms of just Comcast and Disney actually own something that you have heard of, Hulu. So Disney, a direct-to-consumer business, operates different, obviously direct-to-consumer streaming services. And this is in the form of Disney Plus, which just came out, ESPN Plus, Hotstar, which is another streaming service in India. Although the company has said that now with the rollout of Disney Plus, they're probably going to modify Hotstar in India, probably going to call maybe Hotstar Plus or Hotstar Disney Plus. Disney hasn't given too much details on that. We'll probably see that in the many quarters ahead as they continue to roll out Disney Plus throughout the world. Previously, before the 21st Century Fox acquisition, Disney only owned 33% stake in Hulu. After the acquisition, they purchased another 30% or so, and then they also purchased approximately 7 to 10% stake from AT&T. AT&T used to own Hulu, but no more. Disney bought that. And the rest of the 33% is actually owned by Comcast, who's actually what's called a silent owner. So time will tell, but I think Disney will probably try to buy, if not already, the stake, Comcast stake in Hulu, which may be why Comcast is trying to roll out Peacock, because they know that, after Disney probably buys their stake in Hulu, Comcast won't really have any other streaming service available. So what might be interesting to see is maybe Comcast partners with Disney, rolls out Disney Plus, maybe has some sort of deal. Maybe if you buy a package from Comcast, you'll get free Disney Plus, or you can buy that as a package. Comcast, if they were smart, they would try to do something like that before a company like Apple, let's say, tries to step in and do something like that as well. Okay, and then as far as revenues, this is actually pretty simple. Disney makes money on advertising, affiliate fees, and subscription fees. So whenever a company, let's say Netflix, for example, if they offer Disney content, again, Disney has since pulled most, if not all, of the content from Netflix, but before they were pulled, Netflix would give Disney a portion of their subscription fees back to Disney. So how would this get determined? Well, again, Nielsen ratings comes up to play. So whenever they analyze the various shows and movies, Disney can collect money on advertising and subscription fees. So anytime someone buys Disney Plus for $7 a month, or Hulu, whatever it costs, they collect money on subscribers. And then expenses, again, very similar to studio entertainment and media networks. They have programming and production costs. So they incur production costs whenever they make their own TV show, like The Mandalorian, and of course, standard expenses to note, SG&A, and depreciation and amortization. Okay, and we mentioned earlier about strategy, corporate forces. Something that we're going to do right now is we're going to deploy something called Porter's 5 Forces and the 6th Force. So most of you should be familiar with Porter's 5 Forces if you ever taken a management class in school. Basically what that is there's basically 5 forces which were invented by Michael Porter in the 80s. He was a Harvard Business School professor, And actually, in the 90s, two other people came along, Brandon Berger, also people from Harvard and Yale. They came along and came up with a sixth force. So we're going to go with a sixth forces model to honor the additional contribution. So we have, and the contribution was from Neil Buff and Brandon Berger, which you can read a little bit more about on your own if you want. So we have six forces: competition, new entrants, buyers, suppliers, substitutes, and complementary products. So first we have competition. So being a media entertainment behemoth, Disney competes with various competitors along its divisions. So they compete with Royal Caribbean, they compete with Six Flags, Universal Parks, they compete with Netflix, even their Marvel brand they compete with DC Comics, although that's kind of a joke because DC Comics really hasn't been making any great movies recently, and there's actually speculation that Disney actually might buy DC Comics from Warner Brothers because maybe they can do a better job, I don't know. And obviously with Disney Plus, they compete with Netflix, as I said, but also with HBO Max, all these other ones. Although I tend to believe that they're not direct competitors. Reed Hastings said it best, that they see themselves as complements, not really competitors, because, typically, at least for me, I have a subscription to Netflix, Disney Plus, and to other ones, and other people. I've yet to meet someone who only has a subscription to one of these streaming services. And although a lot of people mention that, what's stopping someone from quickly canceling a subscription and moving to another one as new content comes to play, I don't really know anyone that does that, honestly. I mean, I think fluctuations in their subscriber numbers could be a multitude of factors. I think there are people like that exist, but it seems like a lot of work planning, this company comes out with this in March, so I'll cancel it after I binge watch it. That's actually something that Disney's been doing, is they're releasing their content on a weekly basis instead of all at once. So it sort of combats the effects of binge watching. Next, we have new entrants. So how likely it is for a company to set up a streaming service or a theme park or a cruise ship company is important to note. Streaming services seem to be pretty simple to set up as long as you're a multi-billion-dollar entertainment conglomerate, or in the Apple's case, if you have hundreds of billions of dollars in cash to invest in content and purchase content, all that other stuff. But I think there is a limit for just the number of people that can enter. I also think Disney has a great brand, so I think, would you rather purchase something that's the name is Peacock or Apple TV Plus if you don't own Apple TV products? Apple TV Plus is great because Apple's able to give it to anyone that buys a new phone. But if you don't own an Apple product and you're not part of the ecosystem, I don't really think you're very likely to subscribe to Apple TV Plus. Disney themselves, they appeal to a very wide demographic. And obviously the theme park, I'd be hard pressed to think it'd be very easy to set up a theme park as iconic as Walt Disney World in Florida. And then, in the question mark, there could be a new form of vacation, a new form of entertainment that we haven't really heard of yet. How likely that is to happen right now? Probably not very likely, but, who knows? Then you have buyers. So buyers is by far the easiest to think about. Buyers are you and me. We go to the theaters, we buy cable TV packages, although if you're my age, you're probably not doing that. You're more of someone that cord cuts, or maybe you've never even owned a cord and you just subscribe to Netflix and Disney Plus. And then you have corporate buyers, so Comcast and AMC, AMC Entertainment has to buy the content, although honestly, I don't really think there's any purchasing power here at all because one, Disney appeals, as I mentioned before, to such a wide demographic market that even if one specific demographic doesn't like Disney products, I think Disney is well secured and they have great products. So I don't really think they have to worry about their bargaining power of buyers too much. So next we have suppliers. Again, I think this is actually a very low threat to Disney just because Disney makes their own content in terms of studio entertainment and their media networks. That's all them. So they don't really depend on any one major supplier. I would say with ESPN, they have major sponsors with the NFL and the MLB, but you know what? ESPN is such a strong brand that I don't think there's too much a threat there. And obviously, a pretty big threat, at least right now in the news, is the coronavirus in China. So what might that do to, let's say, their ticket sales for the upcoming films, Mulan, or anything that's getting rolled out immediately for China? And then India, we already mentioned they have a foothold in Hotstar in India. So, and I think that's a growing brand presence in India, which is very good. So they're probably well ahead of the game in terms of their competitors. Next, we have some substitutes. So when we think about Disney in their various divisions, we can think first on theme parks. So an alternative of going to a theme park is just going on a different vacation. So going to the Caribbean islands or going to Hawaii or to Europe that doesn't involve a theme park is obviously a substitute. Next, if we go to the studio and entertainment business, we can think about if consumers still want to go out to see the movies, they don't need to watch any Disney movies at all. And when we think about direct to consumer, we can think about instead of Disney Plus or its competitors, we can go to YouTube instead. People can just watch videos on YouTube. And we can think about virtual reality and augmented reality. Once that becomes a more pervasive technology, maybe people will do that instead of theme parks or any of the other divisions. The next and last force we have is complementary products. So with the rollout of 5G and newer, smarter, and bigger phones, while that's not a threat for Disney, we think it complements their products. So what used to take minutes or hours to download high quality video and TV shows, now with 5G would take seconds. And with the screen quality as it is now and going forward, we'll probably be able to watch 8K video on our phone. It would make us a lot more likely to subscribe to Disney Plus versus a cable TV provider just because we can download Disney Plus on our phone, watch amazing content, get immersed. And who knows, with 5G and 6G and beyond, who knows what products or services Disney can offer. Maybe they could even develop virtual reality and augmented reality theme parks eventually. With 5G, it would be a lot easier. So instead of actually selling tickets to the physical theme park and attractions, maybe they can sell, quote, a virtual ticket to them via virtual reality and augmented reality. So we think that these technologies could prove to be helpful for Disney's strategy instead of a threat. So the next few slides, I'm going to go into more in-depth into Disney's studio entertainment business. I'm not going to go super in-depth in each of the divisions. I just picked studio entertainment because I feel like for the most part, people listening to this presentation will be somewhat familiar with some, if not every single piece of this business. So to start with, I've dove deep into every single movie that Disney and all other movie distributors have ever released since Q1 of 2015. That's right, I went on Box Office Mojo, I downloaded all the movies, and approximately every quarter, over 300 movies are shown around the world, and I downloaded all that for the last 5 years. So a lot of movies, and basically counted up all of the box office sales of all of Disney's movies and classified them under Lucasfilms, Marvel properties, Disney classics, Disney sequels, and Disney new. So just to quickly mention Lucasfilms, for those of you who may not know, that's Star Wars and any other property associated with Star Wars. Marvel, that needs no introduction. Disney classics, so that those are films like Snow White, Sleeping Beauty, etc. Disney sequels are things like The Incredibles 2, the Pirates of the Caribbean franchise, stuff like Cars 3. And Disney New is basically, I just call it Disney New because it's basically an experimental division. You know, as you can see, their budget on the rightmost column, they devote 22% of their budget to these films, and they may or may not be successful. And as you can see on their profit margin, it's their lowest profit margin in terms of the budget that they outlay versus the numbers at the box office that they get. But this is a critical division because Disney can't just rely on the strengths of Marvel and Lucasfilms. It needs to also innovate itself. So this table, obviously working our way from the left to the right, we have global box office numbers, which is the total box office numbers. Now, something quick to note for Disney New, I included Big Hero 6, which technically came out in Q4 of 2014, but because the movie was still showing in Q1 of 2015, I included its numbers in Q1 2015, and I did not adjust it per quarter. If for those of you listening who want to go super in depth in numbers, that I did not bother stripping out because it was, I would say, too complicated for this type of analysis. And then working our way on the budget, these are the published budget numbers that I could find on Box Office Mojo. Again, some of these budget numbers may not be accurate, although I was always sure to use the highest estimate of the budget. And then we get profit. Obviously, it's box office minus budget, and I compute a margin. And date diff is basically the amount of time in days between releases. As you can see, Lucasfilms has on average each film since Q1 2015 1,065 days difference on release. Now, why might that be the case? Well, Lucasfilms, the last movie before the Star Wars Force Awakens came out was Star Wars Revenge of the Sith, which was the third movie of the prequels, which came out in 2005. So obviously that was a long time from the last film, which sort of skews the number, but I think it's important to note. Next we have Disney sequels in terms of just date diff, which averages about a year, while Marvel's averages a little over 4 months. So, and Disney New, you can see as the shortest date diff. So it's very obvious from these numbers, Disney New is not very profitable, and they're constantly churning these movies, hoping to get a great movie out of it. Okay, now this graph shows market share. Now, there are more than 7 studio distributors, but I only pick the top 7 to keep the graph somewhat more simple. So we have Warner Brothers, Universal Pictures, Paramount Pictures, Walt Disney Studios Motion Pictures, 21st Century Fox, Lionsgate, and Sony Pictures Releasing. Now, the big dark blue line that just skyrockets and just towers over all of the other colors is Walt Disney. Now, if you look way into that chart, if you can sort of see it, In cyan, light blue, that's 21st Century Fox, which Disney recently purchased. Now, I took the numbers going back only to Q1 2018 to now, and I combined both the film sales of all of Disney films and all of 21st Century Fox in bright pink. As you can see, it still towers over the rest, except we can see there was a dip Q3 2018 to Q1 2019. Again, this took a long time to put together. I had to go through literally thousands of movies, compiled all of them in spreadsheets, and analyze them. Next, I did a combination of Disney and 21st Century Fox in pink, and then in purple, I combined all of the others. Now, as you can see, even though I combined all of the other films, there are times where Disney and 21st Century Fox combined actually has more market share than everybody else. Now, this slide took me a while to put together, but this basically is showing the top films along that time stretch. So if we think about, if we go from left to right really quick, if you can see, Disney's lowest point was Ant-Man and when Age of Ultron came out. Now, some of you might think that Age of Ultron was a successful film. Well, it was, but at the time, Jurassic World was released and it just towered over Age of Ultron. And Ant-Man, we're going to talk about a little bit, but Ant-Man is by far the worst Marvel's franchise in terms of both profit and box office numbers. I'm not exactly sure why Disney decided to make a second one. So these are very important to note. And then if we move forward, you can see that the chart for Disney 21st Century Fox actually eclipsed the others when Star Wars Force Awakens came out. So that film was a big success. But then it dipped again when Finding Dory came out, because at the same time, you had other films coming out which just did a lot better at the box office. And then this massive drop in Q3 2017 happened because Spider-Man, which obviously was distributed by Sony, not Disney, even though it was a Marvel property, it came out, and Despicable Me 3. And we have Cars 3, which is the only thing. I really hope they stop making Cars 3 and Cars 4 franchise, just because that film had horrible profit numbers and numbers at the box office, not a successful franchise. So hopefully Disney will learn their lesson and won't make any more films. And if we move forward, Avengers Infinity War came out. Again, Disney came out on top, but then got smacked down again. They tried to release a sequel to the Ralph Breaks the Internet, but unfortunately they just got demolished by The Grinch and by Venom, which just completely destroyed Disney. And then Disney came out on top again one last time when they came out with Avengers Infinity War. And since then, they have not been able to take back a dominant market share, even with releases like The Lion King and Frozen 2. Hopefully, with some of the films in their pipeline, they'll be able to recover. Next, we're going to dive even deeper in each of Disney's unique franchises. So, starting with Lucasfilms, in purple, we have date diff. If you remember from the table before, date diff is the difference in days among release dates. So obviously the date diff when Star Wars The Force Awakens was massive, because the last Star Wars film, as I mentioned, was Star Wars Episode 3 Revenge of the Sith, which was released in 2005. And in pink, we have profit. So this is after you subtract the budget from the global box office numbers. Now, Star Wars Force Awakens obviously was the peak. You know, there was so much hype and buildup. There were rumors that, Harrison Ford was coming back, all these other things that was just pushing up the film. And which is why all the other films that were released after that just couldn't live up to it. Rogue One came out, took a massive dip. Last Jedi came up a little bit, and then they came out with Solo, which just got horribly destroyed. I mean, they basically didn't make any money on that film. I really hope they don't make another Solo film. And then they came back with Rise of Skywalker, and as you can see, they made less money on Rise of Skywalker than they did on Last Jedi. Now, I don't know if that was because of the bad buzz and publicity around it, or just because, you know, rising streaming services, less people going to the box office, whatever it is, they're making less profit than they did in The Force Awakens. And as far as Lucasfilm goes, we have 3 things coming out in development. We have the Chapter 2 of Mandalorian coming out in October. So hopefully that would give us a boost for Disney+. They're also making a film for Rogue One, a prequel called Anthology, which is in development. And finally, they have a Disney+ series in development revolving around the story of Obi-Wan Kenobi. However, the Rogue One's prequel and Obi-Wan Kenobi series, from what Bob Iger mentioned on the previous earnings call, we probably won't see that film or that series probably until the latter half of 2021. So hopefully in the next earnings call, we'll get more guidance on those films. Next, we have Marvel. So in pink, again, pink is profit, purple is date diff. So as you can see, there's quite a few more films. Highest profit is, of course, Avengers Endgame, followed by Avengers Infinity War. As you can see, the date diff was the highest in Captain Civil War. Now, something interesting, after Ant-Man took such a hit, I guess Marvel went back to the drawing board, did a lot more studying, research, analysis. They made sure everything was right. They probably even canceled planned films because they really needed to get Captain America Civil War right, because they took such a dip in profit. I mean, if you look at the numbers from Age of Ultron to Ant-Man, this is a massive failure for Disney. And then after that, they released Doctor Strange, the second chapter of Guardians of the Galaxy, and Thor Ragnarok. And as you can see, the purple line is basically flat because something interesting is the amount of days between Doctor Strange through Thor Ragnarok were actually the same. And as you can see with their profit actually stayed flat. Rose a little bit when Guardians of the Galaxy came out, but basically flat. And then you can see the purple line collapsed. So they immediately released Black Panther as soon as Thor Ragnarok came out, and you can see their profit just started to climb. Then they came out with Infinity War, as you can see, purple line even going down further. So they pumped out Black Panther and Infinity War pretty much back to back, and their profit just skyrocketed. And as you can see, the purple line even flattens. So they immediately came out with Ant-Man 2, and as you can see, their profit just got completely destroyed. And actually, if you compare their profit on Ant-Man 2 to Ant-Man 1, there really even isn't much of a difference. So after all of these Marvel films, people really aren't going to see Ant-Man 2 any more than they were seeing Ant-Man 1. So hopefully Disney learns their lesson and won't try to make a third Ant-Man movie. And anyway, after that, they took another long break and came out with Avengers Infinity War. And then really, as you can see, the purple and pink lines actually intersected. So they came out with, they came out with Captain Marvel and then Avengers Endgame. So as you can see, they took a long time from Ant-Man 2 to Captain Marvel. And then as you can see from the purple line, they immediately released Endgame. So we're going to have to see what they're going to come up with next, but they're coming off of a very high mark. So what's to come? Now, obviously, as we discussed before, Marvel has the highest profit margin, highest box office numbers. So obviously Disney Plus is going to have a lot of Marvel content. So so far we know that WandaVision is coming out, Loki is coming out, Hawkeye, The Falcon and the Winter Soldier, and something called What If, which I'm not exactly sure what that is, but it's coming out to Disney Plus soon. And then movie-wise, Phase 4, they're coming out, of course, with the Black Widow movie, Eternals, Shang-Chi, a third Doctor Strange movie, a fifth, I think we're up to the fifth Thor movie, a second Black Panther movie, a third Guardians of the Galaxy movie. And then after this, the projections get a little bit more murky, so I actually had to dig really deep into Marvel leaks, and I could find that a Silver Surfers movie is supposedly coming out soon, a Fantastic Four reboot. They're doing Secret Wars, which I think is pretty cool for those of you that follow Marvel Comics. And supposedly they're going to do a Dark Avengers movie. Again, these movies are coming in years and years and years from now. Next, we have Disney Classic. So as a reminder, pink is profit, purple is date diff. Now, talking about the worst films, we have Alice Through the Looking Glass. Now, this film was so bad in the box office that Disney took a very long break. As we remember when we talked about Ant-Man, they took a break, they went back to the drawing board, they did a lot more due diligence on their movies and everything, and they came out with Beauty and the Beast. But you know what? Johnny Depp really wasn't a great pick for Alice Through the Looking Glass. He also wasn't a great pick moving forward with the Pirates of the Caribbean franchise, which I'll show you in a little bit. Did really, really bad. So I'm really hoping that Disney does not pick Johnny Depp to star in any of their films moving forward, because he's been quite a stinker at the box office. And as you can see from the purple line, they came out with too many films after Beauty and the Beast. I think maybe they got a little arrogant. So they came out with Dumbo. Dumbo had a massive budget, but really did nothing at the box office. These were just horribly made films. I don't know why they got so much clearance. After that, they took an even shorter break, came out with Aladdin, which had great success. Then Lion King. So two back-to-back champions. Which is unusual, but given the franchises, the Aladdin franchise and the Lion King, it's no wonder that they did so well. But one might think why Disney needed to come out with two amazing franchises back to back, maybe because they weren't able to come out with other movies, so they had to maybe sacrifice their best brands. Hopefully that won't hurt them moving forward. And next, as far as future releases, they're coming out with Mulan now, and there's talk that they're going to come out with Cruella, which, as you may know from your childhood days, Cruella was the bad villain in the movie 101 Dalmatians. There's also talk they're gonna come out with The Little Mermaid, a second Jungle Book movie called Jungle Cruise. They're going to come out with a new Aladdin movie. They're going to come out with two Snow White movies. These are some pretty great films. Although, to start with Mulan, I think given the coronavirus, there may be some difficulties in the box office, given that Mulan's target audience is probably in the Chinese market. So we'll have to see what happens. I'm thinking maybe if they delay the release in China, maybe in a few months, they'll be able to re-release Mulan, although you have to question if they're trying to release 10 months worth of movies in China in, let's say, 3 months, whenever they end up opening the movie theaters back up, will people even want to watch the Mulan film? So this could actually really damage Disney's, just their plans and production. And next, as far as Disney Plus, They're going to be rebooting the Lilo and Stitch franchise. They're going to come out with an Aladdin series in Disney Plus. There's rumors that they're just going to come out with something, The Sword and the Stone, as well as a Peter Pan series in Disney Plus. Next, we have Disney sequels. So I mentioned Pirates of the Caribbean. Pirates of the Caribbean profit was almost as bad as Ralph Breaks the Internet. I really hope they don't make another film of this franchise. Obviously, there's the star is Incredibles 2, although if you think about going back Incredibles 1, they took forever to come out with this film, so who knows, by the they'll probably take another 10 years to make a third Incredibles movie. I really hope they don't keep spinning out Incredibles movies just like Cars and Pirates of the Caribbean. I hope they come out with other ideas as well. I would really hate to see an Incredibles TV series. Anyway, after that, they came out with Toy Story 4, and rounding up at the top is Frozen 2. Next, we have Disney New. So as you can see with this chart, we actually have our first negative box office numbers. Now, if you remember from before, Disney New is their experimental division. So they're coming out with a lot of products. Now, as far as the lines, remember, pink is profit, purple is date diff. So as you can see, date diff is pretty much like constantly. They're coming out with so many films back to back to back to back, and nothing really hits. The only things that really did amazing at the box office was Big Hero 6, and then it took them actually a long time to repeat that success until Inside Out came out, and then Zootopia and Moana and Coco. But if you see in between, you had all these horrible films that came out, and actually their worst film ever is probably Strange Magic and Wrinkle in Time. Both of them lost money. Strange Magic lost over $100 million at the box office. And you know what? Everyone associated with Strange Magic, their careers, if you look on IMDb, were completely destroyed. And next we have two films coming out with Pixar. Onward's supposed to be coming out, and Soul's supposed to be coming out. I think both of them this year, although they will probably have delayed China releases given the coronavirus. Although they could also have delayed European releases as well. So this comes into question the whole fact of just projecting box office numbers. It becomes very difficult when you're not actually able to go to the movie theaters. Thank you so much for listening. I think we're going to stop it here. If you like this series, please let me know if you'd like to see other ones. And if you'd like to see other ones, please let me know any specific areas. I covered a lot of information, so if you want to learn more about discounted cash flow, I can make a series for that. I really don't want to go all the way in depth with Disney just because this is an introductory presentation, but I wanted to show a little bit about what's involved in terms of just researching. Compiling the information from Studio Entertainment actually did take me a long time, and you'd basically follow the same thought process when you're going to the other divisions. Like, for example, if you go to theme parks, you would compile a list of all the other parts of the world. What you could also do is check the demographics of each of the countries that Disney's in, and you can obviously identify the revenue trends, cost breakdown of each of the theme parks, pay attention to earnings calls, etc. Then you can move on to media networks, so you can study trends as far as just cable subscriber numbers for companies like Comcast, DirecTV, and all of that other information that you can get. But yes, we're going to stop it here. Thank you so much for listening. If you made it all the way through, I really appreciate it, and I hope you have a great day. Thank you.